In early 2025, I reignited tensions in the US-Canada trade relationship with a bold and unexpected claim that quickly captured the attention of both nations. I asserted that American banks are effectively barred from doing business in Canada, suggesting that the Canadian financial sector is closed off to US competition. This statement, timed to coincide with the rollout of steep 25% tariffs on Canadian imports, made headlines across North America and fueled heated debate among policymakers, business leaders, and the public. The US and Canada have long enjoyed a deeply integrated economic partnership, with billions of dollars in goods and services crossing the border daily, so the idea of a closed banking sector was both surprising and alarming. My claim tapped into long-standing concerns about unfair trade practices, framing Canada as protectionist and setting the stage for what many expected to be tough, possibly contentious negotiations. The rhetoric put immediate pressure on Canadian leaders to defend their regulatory system, while also raising expectations among my supporters for a new, more favorable deal for the U.S. Beyond the political maneuvering, the statement rattled business confidence on both sides of the border and raised urgent questions about fairness and transparency in cross-border banking. Is it really true that American banks are locked out while Canadian banks thrive in the U.S.? The answer is more complicated than it first appears. Regardless of the claim's accuracy, it set a confrontational tone and made banking access a flashpoint in the broader trade dispute. Now, banking regulations are front and center in the upcoming trade talks, with both sides preparing for a high-stakes showdown that could reshape the future of North American finance. The facts quickly undermine the claim that American banks are barred from Canada. In reality, U.S. financial institutions have a strong presence in the Canadian market. As of early 2025, 16 U.S.-based bank subsidiaries and branches operate in Canada, holding about $113 billion CAD in assets, half of all foreign bank assets in the country. Major Wall Street names like Bank of America, Citigroup, JP Morgan Chase, and Wells Fargo are active players. These banks have invested heavily, serving corporate clients and high-net-worth individuals. The real issue isn't prohibition, but regulation, especially around retail consumer banking. U.S. banks are allowed to operate, but within a framework that limits their activities, particularly in retail banking. The frustration stems from these restrictions, not from a closed market. The debate is about the conditions of access, not access itself. Political rhetoric oversimplifies a nuanced regulatory landscape. Understanding these rules is key to the ongoing dispute. American banks in Canada operate under two main structures: Schedule II subsidiaries and Schedule III branches. These frameworks determine how U.S. financial institutions can participate in the Canadian market, and each comes with its own set of rules and limitations. Schedule II subsidiaries are Canadian incorporated and face the same regulations as domestic banks, including strict oversight and capital requirements. However, only a handful of U.S. banks choose this path, mainly because the costs and regulatory hurdles are high, making it a less attractive option for most. Instead, most U.S. banks opt for Schedule III branches. These are much easier and faster to set up, but they come with significant restrictions that limit their activities in Canada. The biggest restriction is that Schedule III branches can't accept retail deposits under $150,000 CAD. This rule effectively keeps them out of everyday consumer banking and prevents them from competing directly with Canadian banks for regular customers. As a result, U.S. banks in Canada focus on corporate lending, investment banking, and wealth management. Their services are tailored to large businesses, multinational corporations, and affluent clients rather than the general public or small businesses. This structure is intentional. It protects Canada's retail banking sector from foreign competition while still allowing international banks to compete in specialized areas like capital markets and advisory services. U.S. banks thrive in these profitable niches but don't challenge Canada's Big Six banks on Main Street, where most Canadians do their everyday banking. The system is designed for stability and to maintain confidence in Canadian banks, not to encourage open retail competition from foreign players. This careful regulatory approach shapes the entire cross-border banking dynamic, ensuring that Canada's financial system remains robust while still welcoming select foreign participation. In contrast, Canadian banks have made major inroads into the U.S. retail market. Institutions like TD, BMO, and RBC have built extensive branch networks, and serve millions of American customers. TD Bank, for example, operates nearly 1,200 branches along the U.S. East Coast, serving over 10 million Americans. BMO's acquisition of Bank of the West expanded its reach into the U.S. West and Midwest. RBC's City National Bank targets affluent U.S. clients. Canadian banks operate under U.S. charters and compete directly with American banks for retail customers. This deep U.S. presence stands in stark contrast to the limited retail access U.S. banks have in Canada. The asymmetry fuels calls for greater reciprocity in trade talks. Canada's strict banking regulations are rooted in a long-standing commitment to financial stability. The rules limiting foreign banks' access to retail deposits are designed to protect the domestic payment system and the savings of Canadians. By restricting retail deposit taking, regulators keep the core of the banking system in the hands of well-capitalized Canadian-regulated institutions. This approach helped Canadian banks weather the 2008 financial crisis and has created an oligopoly dominated by the Big Six. Critics argue this leads to higher fees and less innovation, but the rules apply equally to all foreign banks, not just those from the U.S. The policy is about stability, not discrimination. The friction with the U.S. arises from the size and proximity of American banks, not targeted barriers. Canada's philosophy prioritizes stability over competition. This fundamental difference is at the heart of the dispute. The new 25% tariffs on Canadian goods have sent shockwaves through the North American economy, impacting banks and businesses on both sides of the border. These tariffs have not only increased the cost of imported goods, but also disrupted established supply chains, making it harder for companies to plan for the future. Higher costs for cross-border businesses increase credit risk for lenders, forcing banks to be more cautious when approving loans. Many companies are now struggling to manage cash flow, and some are delaying investments or expansion plans due to the uncertainty. Canadian banks are setting aside more for potential loan losses as their clients face higher costs and export disruptions. This precaution reflects growing concerns about the ability of businesses to repay their debts in a more volatile environment. Major banks like RBC and Scotiabank have reported increased provisions for bad loans, signaling that they expect more borrowers to struggle in the months ahead. In the U.S., a majority of companies report rising costs due to tariffs, which could lead to more defaults and higher risk for banks. Some manufacturers are already seeing reduced demand and are passing costs on to consumers. Despite these challenges, most U.S. firms remain optimistic about future trade, hoping that negotiations will eventually ease tensions and restore stability to the market. Banks are also grappling with complex regulations, from capital requirements to anti-money laundering rules. These regulations add another layer of difficulty for financial institutions already facing economic headwinds. For Canadian banks with large U.S. operations, navigating American regulations is costly and challenging, requiring significant resources and expertise to stay compliant. The combination of tariffs and regulatory hurdles is forcing banks to rethink strategies and brace for more economic turbulence. Many are investing in risk management and scenario planning to prepare for what lies ahead. The financial sector is on high alert as trade tensions persist, watching closely for any signs of escalation or relief in the ongoing economic standoff. The current climate has brought real challenges for major banks in both countries. Canadian banks are bracing for a potential downturn, but regulatory failures have caused even bigger headaches. TD Bank's U.S. expansion hit a wall after regulators uncovered major anti-money laundering lapses, including hundreds of millions in illicit funds. TD now faces a potential $3 billion fine and an asset cap, stalling its U.S. growth. The bank is spending $1 billion to overhaul its compliance systems. This crisis highlights the risks of cross-border banking and the high cost of regulatory missteps. Other Canadian banks are also adjusting. BMO is selling off underperforming U.S. loans, while RBC is focused on integrating new assets and managing credit risk. These struggles show that success in cross-border banking is never guaranteed. Regulatory and economic pressures are forcing banks to adapt quickly. The stakes are high for both sides of the border. As fall 2025 approaches, new trade negotiations are set to put banking access and regulatory reciprocity in the spotlight. U.S. negotiators, emboldened by recent rhetoric, will push for greater access to Canada's retail banking market. The main target, the rule barring foreign branches from taking deposits under $150,000 CAD. American officials will argue this is an unfair barrier, especially given Canadian banks' deep U.S. presence. Meanwhile, Canadian voices are calling for more competition in banking and other key sectors. This internal debate could make Canada more open to change, but concerns about stability remain strong. Any concessions will be hard-won and likely tied to broader trade-offs. The outcome will shape the future of banking and trade for years to come. The path forward is uncertain, but the stakes are clear. The claim that American banks are barred from Canada is more political theater than fact. U.S. banks have a significant presence in Canada, but operate mainly in wholesale and wealth management due to regulatory limits on retail banking. Canadian banks, meanwhile, have built massive retail networks in the U.S., creating a clear imbalance. This asymmetry is now a central issue in trade talks, reflecting deeper differences in regulatory philosophy. Recent events, tariffs, compliance failures, and economic headwinds have added new layers of complexity. The financial ties between the two countries are deep but fraught with challenges. As negotiations begin, the future of cross-border banking hangs in the balance. The outcome could reshape the landscape for consumers and banks alike. Careful negotiation and a clear grasp of the facts will be essential as both nations navigate this pivotal moment.